computer. Welcome, members, friends, and new listeners to the Global Justice Report. This is a new online production of the Center for Global Justice in San Miguel Allende, Guanajuato, Mexico. I'm Betsy Bowman, and I'm your host for today's program. The Center for Global Justice, El Centro para la Justicia Global, is a multinational and bilingual research center in San Miguel Allende, Mexico. The center is devoted to research and learning for a better world. Since 2004, when we first came to San Miguel, we have offered educational programs in English for the many expatriates who live here and the many visitors who used to come in the winter and in the summer. And we also have programs in Spanish for the larger community. Our vision is very ambitious. It is nothing short of moving control of economic life and relations with Mother Earth from the 1% to the 99%. Coronavirus has set in relief the failures of neoliberal capitalism and our non-existent health care delivery system. Our weekly Global Justice Report will explore various grassroots democratic solutions, including self-management, cooperatives, mutual aid, and public banking. If you have suggestions for future webinars, you can type them into the chat box. And that's also where you can type in your questions for today's speaker. It's on the right-hand side of your screen. We are indeed fortunate to have Ellen Brown as today's speaker. She's the founder of the Public Banking Institute. She's written a number of books, most of which are about the banking industry and what a problem it is. The Web of Debt was one of her first books about the Federal Reserve and the economy. And over here, her other book about public banks, the Public Bank Solution. And then her most recent book is Banking on the People. And if you ever had the feeling that there was something kind of funny going on with all of this money coming out of the Federal Reserve and moving into hedge funds and banks, you're right. There is something very funny going on. And Ellen is going to be able to help us understand that today. So, Ellen, thank you so much for being with us today. And Ellen is going to talk about why banking needs to be run as a public utility. We could have nationalized the banks in 2008, but maybe we'll get another chance to now. Ellen, welcome to today's show.
Thanks, Betsy. It's great to be talking to you. I wish I was there in person like I was a number of years ago when you invited me down for a conference, which was great. I really enjoyed your group and I really enjoyed your city. Looked like a fine place to retire for those of us thinking of some place to emigrate to in these trying times. So shall I should switch right over to
Go right ahead.
All right, so I've got a PowerPoint, which is probably too long, but it's sort of I get into these things. So I'm gonna put up my PowerPoint and I'll talk from there.
Great.
Okay, so why banking needs to be run as a public utility. State and local governments in the US are in serious trouble. Their taxes, of course, are way down because businesses have been shuttered and people are unemployed. and costs are way up. Where one of them is increased unemployment insurance, but costs in general are up. And unlike the federal government, which can go into debt until the cows come home, it seems, nobody seems to be objecting to $1 trillion deficits. State and local governments are required to balance their books. In fact, it appears that there may be a push to, they're not allowed to go bankrupt, but Mitch McConnell, who is the majority leader in the Senate, said that he'd rather see the states go bankrupt than to be able to use CARES relief money for their pension funds. So obviously there's a push to actually try to privatize the pension funds, or to privatize everything state and local governments have. And that's what will be reduced to if we can't find some other source of income. So the CARES Act was nearly $3 trillion of funds for bailout funds for all related to this COVID-19 crisis. But only 5% of that was allocated for state and local government. So it's $150 billion out of $3 trillion. And of that, there are restrictions put on what it can be used for. It can't be used for anything in the budget before March of 2020. Well, that's virtually all their expenses, because they budget everything before they spend it. So they budget teachers and they budget hospitals and all those things they do. They're all in the previous year's budget. So even the funds that are being made available, they can't use for the things that they really need them for. Of that $3 trillion bailout, $454 billion was allocated to these special purpose vehicles. That there were 11 of them originally. And one of them is it's called the Municipal Liquidity Facility, and it is where state and local governments can sell their bonds, but it's at a penalty rate. So you're paying the market rate plus a penalty. So why exactly are state and local governments getting penalized for a virus that obviously is beyond their control? Wall Street and the stock market do not have these problems. The Federal Reserve has very neatly bailed them out. The stock market is back up to where it was. That most of that $454 billion is being used, it can be leveraged into $4.5 trillion of credit from the Federal Reserve. So the Municipal Liquidity Facility was set up by the special purpose vehicles were set up by the Fed and the Treasury jointly. So they're now suddenly working together instead of the independence of the Fed that we always heard that they had to maintain. Now they're working together because the Fed has acknowledged basically that they can't do it without the Treasury. So $454 billion of our taxpayer money is going for this $4.5 trillion bailout from the Fed, of which most is going to corporate America and the banks. The Fed first demonstrated that it had basically unlimited funds after the 2008 crisis, and it did quantitative easing to the tune of $4 trillion, which at the time everybody said, can they do that? But at least that was spread over a certain amount of time. In the last 4 months, they have added $3 trillion more, and it's almost all for big corporations. Plus, they have been extremely generous to the banks. They, for the first time, have opened their discount window to all banks in good standing to borrow for essentially for free. It used to be that the discount window was somewhere that banks didn't go, because you could borrow there, but at a penalty rate. And if anybody knew you were borrowing at the discount window, it meant that nobody else would lend to you. So it meant your bank was in trouble. But now the Fed has said, no, come one, come all. We're throwing the doors open, free credit, come to us. And they've eliminated the reserve requirement, the 10% that you have to hold back 10% of deposits. And they set up these special purpose vehicles where the banks can get rid of their toxic assets by basically selling them off. And they'll be purchased by the special purpose vehicles with loans from the Federal Reserve. And there are no strings attached on this virtually free money or interest-free money. There's no requirement that they use it for small and medium-sized businesses, even though in the Fed's press release, they said the reason they were doing this was to make credit available, because of this urgency to make credit available to the local economy. But they haven't. There was no requirement in these changes that the banks would use it for that, and they haven't. They didn't lower their credit card rates. They're still hovering at 21% on average, compared to Canada, which actually did. Those banks actually did lower their rates to 11%. So that can obviously be done. Apparently in Canada, they didn't pass a law. It wasn't a mandate, but it was sort of, they got leaned on. It was like, do it voluntarily or we'll make you do it. So anyway, that could be done, but it wasn't done here. And so the banks are getting a free ride. And you may wonder, I've certainly wondered, why are the state and local governments being penalized while the banks are getting red carpet treatment? And the reason is that it was actually another stealth bailout. As Betsy pointed out, the next time the banks failed, we were hoping that Congress could say, all right, you need a bailout, but this time we're going to put some restrictions on it. You can't just use it for anything you want. You can't gamble it away. You can't just use it for your own bottom line and private profits for your shareholders and your CEOs. You need to have a public purpose, which is what corporations were set up for originally. Originally, they were supposed to have a public purpose. So you have to, we'll help you. Obviously, you need the public to bail you out, but we, the public, would like to be served in return. But they bypassed that possibility because the Fed has just quietly bailed the banks out once again. And I mean, you could go back 200 years. They've been needing a bailout routinely because of the way the whole system is set up. But if you just going back to 2008, that was called a liquidity crisis, meaning that they couldn't get cheap money to borrow. And their whole system is based on the ability of banks to borrow cheaply. And so that's when the Fed dropped interest rates to 0.25%. But in that case, it was the interest on Fed funds, the rate at which banks borrowed from each other. It wasn't like this free money at the Federal Reserve itself. And in 2010, we had the Dodd-Frank Act, where Congress said, Obama announced triumphantly, no more bailouts. That's what this meant. But the way they did that was that the alternative was going to be bail-ins, which meant they would take the money of the bank's creditors instead, which included the depositors. I mean, we were theoretically covered by deposit insurance, but only to $250,000, and any deposits over that could be taken. And bail-ins were then tried in Europe, in Italy particularly, and they were a disastrous failure. There was one man that hung himself with a note on his chest blaming his bank because they had taken all his money. He didn't realize he was investing in these cocoa bonds that could be recalled. He thought they were regular, safe sort of CDs from his bank. So then in Europe, they went back to bailouts. And meanwhile, in the US, the banks quit borrowing from each other because they didn't trust each other. So the Fed funds market basically died. And they also quit borrowing from each other because the Fed was paying interest on excess reserves for the first time in 2008, which meant you could make like 2% just by leaving your money at the Fed. So what was the point of taking a risk of lending it to other banks? So instead, when banks had to borrow, they were going into the repo market, which is basically secured loans, secured overnight loans. It's complicated and I won't try to explain it here, but it too proved to be risky. And in September 2019, the repo market died. So the shadow banking system that was propping up the chartered banking system has also died. And it died basically because the lenders didn't trust the borrowers and they didn't want to put their money at risk. the interest rates shot up to 10%. They should have been maximum maybe 2% or so. And so the reason it was risky was largely because the hedge funds had invaded the repo market, and they were risky and nobody wanted to lend to them. So that was one reason anyway. So the Federal Reserve, since it considers its mandate to save the banks at all costs, then stepped in and became the repo lender of last resort. But by March, they were putting up $1 trillion a day in the repo market. Not that they were actually spending $1 trillion, but they were putting that much up in these overnight loans for liquidity. And this was available again to the shadow banking system, to the hedge funds, et cetera. So that was a non-starter. So the Federal Reserve used the virus as an excuse, it looks like, in order to bail out the banks again. But it was all done quietly, so we can't step in and say, all right, we'll bail you out, but we want you to, behave more like a public utility, behave in the public interest. It's obviously we, the people, the full faith and credit of the United States that's backstopping the banking system. They need this constant pool of liquidity, and only the central bank, which is backstopped by us, is able to give that liquidity safely and securely and reliably. So clearly you are a public institution. You are dependent on the public, and therefore you need to be serving the public. That's the argument we should have been able to make, and that Congress should have been able to insist on, but it didn't happen. The Federal Reserve just took it upon itself to open up its discount window to all comers very cheaply. But you can see that's also an opportunity for state-owned banks that now we too can borrow cheaply, but I'll get to that. So why, the question is, why do we need these bailouts? Why are there always these liquidity crises? Why don't the banks, why isn't the system stable on its own? And the reason is that banks don't actually have the money that they lend. They actually create that money on their books. And that was a conspiracy theory when I wrote Web of Debt in 2007, and I had to argue hard for it. But by 2014, largely because of positive money and some, money reformers that had leaned on the Bank of England, the Bank of England finally acknowledged it. So they said in their quarterly report, they said, contrary to popular belief, banks do not act simply as intermediaries lending out deposits that savers place with them, and nor do they multiply up central bank money to create new loans and deposits. Commercial banks create money in the form of bank deposits by making new loans. And in fact, they said 97% of the money supply is created in that way. So it's not the federal government that's creating our money, as most people think. It is commercial banks when they make loans. How they do it is by double entry bookkeeping. So if you were to go to the bank to take out say a $500,000 mortgage, the bank would just write that money into your account. They don't borrow it they don't take it from anywhere else. They just write it in, and they would put it on one side of their books as an asset to themselves because you're going to pay that back over time. And they put it on the other side of their books as a liability to themselves, because when your check leaves the bank, they're going to have to come up with the money somehow. And that is the hitch. And then they say, well, 500 plus, 500 minus the book's balance, we haven't really created anything. And that's what double entry bookkeeping says. So then when Bank A's check leaves the bank, let's say that the seller was in Bank B, and so Bank A's check goes to Bank B. Bank B then could have been, let's say, theoretically, Bank B was doing the same thing, and it also created a $500,000 loan, which found its way into Bank A. So both banks would have $500,000 going out, $500,000 coming in. So their books would balance. They wouldn't have to borrow. But $1 million would be out there in the form of checks in these checkbooks in people's accounts that didn't exist before. And conversely, when those loans get paid off, then the money disappears. So that is where most of our money comes from. And it would work fine if, in fact, all these banks, traded everything and everybody trusted everybody, but periodically we have bank runs when if the depositors all pull their money out, then there's not going to be any liquidity to cover other depositors pulling their money out. I mean, that's what happened back in 1933 when all the banks collapsed, when the banking system was backed by gold. So there are obviously some flaws in our current system. And the first one is that the liquidity problem, that banks are always making like 30-year loans based on deposits where they tell the depositor that you can come for your money at any time. So what happens if all the depositors clean out their accounts and you've still got these 30-year loans out there? That's what happened in 1933, the It's a Wonderful Life sort of problem. And it's what happened with the Savings and Loan Associations when they collapsed in the 1980s. They had these long-term loans out, and then Paul Volcker, who was Fed chairman, raised the interest rates to 20%. And the savings and loans had these long-term loans out for 5%. Well, there was no way they could get the liquidity, and so they folded. So that was obviously one way around that was that we got into securitization, where banks would sell off their loans to mortgage companies that would sell them to investors. And then the investors would take the hit. But then that's what happened in the 2000s when we had the mortgage-backed, the toxic mortgage-backed securities, and that all collapsed when the investors figured out that these things were toxic and they all started dumping them. So you can see that we've had this liquidity problem with the banking system going at least to 1933, and obviously even before that. I mean, there were bank runs all through the 19th century, 19th century. So in 1933, Roosevelt's government voted in FDIC insurance. So we, the people, backstopped the banks, and that's the only thing that kept them from collapsing. And the Fed funds market was set up where they could borrow the deposits of each other. And then 2008, that market collapsed. 2019, the repo market collapsed. And 2020, so that's where we are now. So you could see that's a problem. And I think actually it's a good thing that the Federal Reserve has acknowledged that they are the ultimate source of liquidity, but they are a public institution. They should be. They're a government institution. They only have their powers because Congress gave them to them. And so if we actually had a system that was run as a public utility with the Federal Reserve at the top, that would be a good thing. And I've written extensively about that in my latest book, Baking on the People. So other problems were obviously, we've left the bankers in control. Private bankers whose mandate is to make as much money as they can for their shareholders, it is not to serve the public interest, are in control of the money supply, creating our money. This is a quote from Robert Hemphill, who was credit manager of the Federal Reserve Bank of Atlanta in 1934. He said, "We are completely dependent on the commercial banks. Someone has to borrow every dollar we have in circulation, cash or credit. If the banks create ample synthetic money, we are prosperous. If not, we starve." And obviously their motivation for creating money is not to serve the public interest. It's to serve their own short-term bottom lines for their investors. Also, private bankers determine where the money goes. So when you deposit your money in the bank legally, that money belongs to the bank. You're just a creditor. So they can do what they want with that money. They can gamble with it. I just saw an email today where JP Morgan lost $3 billion of depositors' money investing in derivatives and stocks and risky things. And before that, there was that London whale deal where they lost $6 billion. But that didn't mean that the depositors don't get their money, because the Fed can then just turn around and borrow from, that JP Morgan can turn around and borrow from the Fed in our current system where they can borrow at 0.25%. But you can see that it's risky business, and it's the private bankers they can give cheap loans to their cronies, and they can they can squeeze whatever the market will bear out of poor people, which is why they can charge 21% interest on credit cards. And that's where small businesses have to borrow these days. They don't get the credit lines that they used to get. And the private bankers can refuse to lend at all if they want to. And then a third problem is just the mathematical problem of how the whole system's set up. And that is that banks create the principal, but they don't create the interest in these loans. So more money is always owed back than was paid in the original loan. I know there's this whole velocity of money argument that it's conceivable that you could pay off these loans because you pay them off month after month. And if the bank pays that money back into the system every month, then it's available to pay the next time around. But they're not gonna, that would entail like hiring their borrowers, which they don't do. The money does not go back into the system. It goes into more loans or into the financialized system. Anyway, the fact is that debt at interest always grows faster than the money supply. And you can see that from this chart, whatever the reason is. Another reason is that the people who get this money that was created in these loans don't necessarily spend it back into the system. As they get richer, they tend to save it. So it might go into the financialist economy where it never comes back into the consumer economy. You know, it just goes round and round in the stock market and it's left to the kids who then invest more and more in the stock market. You know, the rich just get richer and richer and they are not buying more shoes or more food. They've got all the consumer goods they need. They're putting their money into big things like yachts and islands and mansions and buying off politicians and buying medical research facilities, that kind of stuff. So how do you fill that gap between debt and the money available to repay it? With more debt. That's the only place you can get the money. So what you've got is a pyramid scheme, which eventually collapses. You have this push for exponential growth, you know, the growth imperative that's basically ruining the environment. And it is tied to the nature of how our banking system is devised. So that leads to what we call the business cycle, which is a euphemism for this booms and busts that really are a flaw in the system. And every time there's a bust, the rich get richer and the poor get poorer, because some people, the rich, will have money on the sidelines. And so as the poor have to, you know, go into foreclosure or they have to sell off their business or whatever, the rich can snatch it up at fire sale prices. So you've got a progressive widening of the wealth gap and a widening of the debt to income gap as the financialization skims off profits. So you've got this growing disparity between rich and poor, and as Thomas Piketty showed in Capital in the 21st Century, this is not benign. This actually, that wealth disparity results ultimately in market collapses, and we're approaching another such collapse. Or well, now it's collapsed. When he wrote that, we were approaching another collapse. So how do you fill that gap between debt and the money available to repay it? Ben Bernanke famously or infamously said in 2002, it's easy. You just drop money from helicopters. He said it's easy to cure a debt deflation, a deflation caused by the fact that people are paying off their loans and they're not taking out new loans. Just put more money into the system, but which is what they've done, but they're dropping the money into the financialized economy. They are not dropping it from helicopters on the people, which is what the original concept was supposed to have been. And of course, he got that from Milton Friedman, that was back in the stagflation days of, I think it was the 1970s, might have been the 60s. So the central bank has done that, but they've done it only for Wall Street and the stock market. They haven't done it for Main Street. But the potential is there. The fact that they have finally acknowledged that they can create trillions on demand, and it won't necessarily wreck the economy. We haven't seen any great, we haven't had a Weimar inflation yet from all this, or a Venezuela, or a Zimbabwe type situation. But the reason is those hyperinflations were caused by madly printing money to pay off debts in a foreign currency. I mean, they were basically created by speculators who were short selling the currency of countries that they could see were in trouble, and they knew the country was going to go down. The same thing was the Asian crisis, 1998. So the currency, national currency, goes down, 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 and then the short sellers come in selling currency they don't even have, and then buying it back at a lower price, and the banks were then just printing money to feed this engine, and that's where these hyperinflations came from, not because they were printing money for productive things in their economy. So we could see that the potential is there. They can no longer say to proposals for universal health care or universal basic income or, all these things listed here. They can no longer say, we don't have the money. We can't do it because we can't afford it. They've just shown that they could come up with $3 trillion or $7 trillion if you count that whole thing, 4.5 trillion plus $7.5 trillion just in the space of a couple of months, just over a virus. And nobody seems to be, we're not seeing signs of hyperinflation yet. The stock market is going up, but it's not, even if it did hyperinflate, what would be the harm of that? The investors would be perfectly happy with all that. So anyway, there's the potential for universal basic income, national infrastructure bank, universal health care, Green New Deal, free public university tuition, eliminate the federal debt, nationalize bankrupt Wall Street banks. You could just go in and buy them out. You could buy up Amazon or Google or other monopolies that you wanted to break up. First of all, declare them in violation of the antitrust laws or whatever legal mechanism you have to use to do it. But you could buy up the banks. Indira Gandhi in 1967 nationalized the banks, not because they were bankrupt, but because they weren't serving the public interest. That could be done. And we could do that and say, you guys are totally dependent on us and you are not serving us. And therefore we are going to nationalize you. But of course the investors would have a fit. So what you could do is just buy it from the investors. But the complaint will be that would be inflationary, but not really, because recall that we have a great gap in the real economy. All that would be money going into the real economy, not into the financialized economy. And that's where we actually desperately need money to fill that gap. So it would not be inflationary, at least until you filled that gap. In China, unlike what happened in Zimbabwe or wherever, China increased their money supply by 1,800%. Like we're talking about, if we added another 4 trillion for a people's bailout, like they've already done a $4 trillion corporate bailout, that would be, I think, 25% of the GDP or something. I think it would be like 25% of the money supply. I'm not sure, my figures might be wrong. But it would not, the Chinese increased their money supply by 1,800%. 18 times, like not double, not triple, but 18 times what it was 23 years ago. And this bottom line, that's the top line. The bottom line is the consumer price index. It stayed stable the whole time, more or less. You can see it had ups and downs, but it's back where it was to start with. Did not create hyperinflation. Why not? Well, because their GDP went up at the same rate. They were using that money to produce goods and services. If you have supply going up along with demand, prices remain stable. So, you add $1,000 of 1,000 widgets and you add $1,000, it's still going to be $1 a widget. So that's one reason. And also because they didn't necessarily spend the money they got. So the people got richer, but they saved it. And and they are big savers in China, but in the US, we are not such big savers. In fact, I'm sure you've seen these reports about the percentage of people that couldn't even come up with $400 in an emergency, and they're probably in that situation right now. So our people are in debt. US household debt, average debt outstanding, well, I guess that's, anyway, this, you can see with that, families are heavily in debt on average. 80% of Americans must borrow just to meet expenses. So they are filling that gap between money, or between debt and the money available to repay it by borrowing more money. So how much would you need to, or how much money could you get away with pumping into that gap without creating any inflation? It actually works out to $1,250 per month. So that's the actual $1,200 is what they came out for a 1 month payout under the CARES Act. They could do that month after month and it would not be inflationary. And this is the reason it would fill that gap between debt and the money available to repay it. So if you did a UBI of $1,250 a month, and 80% the people that all have debts would use it to repay their debts, you know, they pay down their credit cards or their student debt or whatever, then that money would be extinguished along with the debt. I mean, they'd still have extra money to spend. They'd have that money that previously they had used to pay down debt, but that money would be extinguished. It would not add to the money supply. And the other 20% who didn't need to pay down debt, they probably wouldn't spend it either because they're rich. They've already got all the shoes they want. They've got all the food they want. So they're going to put it into the financialized economy or just save it somewhere. So you would actually not drive up the consumer price index at all. You would just be, in the current situation, you would just be giving people the money back that they were earning previously that they're not earning now. So they would just be spending what they were spending previously. So that's obviously not going to drive up consumer price index. So that's what could be done on the federal level, but whether we can actually get the Federal Reserve or Congress to do these things is another question. But where we can have some leverage is at our state and local governments. And we've found that with our Public Banking Institute and you know, the movement we have going right now in the US. So that would be a way to get control over our own public monies, like our state and local, our tax monies, instead of putting them into Wall Street banks, would be to form our own publicly owned banks. That sounds like a rather foreign concept in the US, like uncapitalistic or something, but globally, 25% of banking assets are publicly owned. And in the 1960s, 50% of banking assets were publicly owned before this big wave of privatization. China is the leader. The 80% of Chinese banking assets are publicly owned, and that's a lot of money. The biggest banks in the world are in China. So if the Chinese wanted to do something like build 12,000 miles of high-speed rail in 10 years, which is what they did do, all they have to do is issue the money through their state-owned banks as deposits on the books, the way all banks do. And then the proceeds from the trains, you know, the fees that they would collect from their passengers would go to pay back the debt. And that's really the way the system should work. You should be issuing credit first for productive purposes, and then whatever it's issued for gets paid back, pays back the loan. In Germany, which is our leading model in Europe, half of German banking assets are in the public sector. This is largely the Sparkassen banks, which every little community has its little Sparkassen bank, which is either publicly owned or a nonprofit, but they're not privately owned. And in the last few years, Germany has become the world's first major energy economy. They've converted, as of 2017, they had converted 41% of their electricity was coming from renewables. And it was largely the Sparkassen banks and KfW, the public development bank, that had funded all that. And today, in this current crisis, KfW is providing 1% loans to small businesses, and they're easy to get, not the sort of hassles that we have here in the US. And then, since you're in Mexico, there's Mexico's AMLO, President Lopez Obrador, who has embarked on this project. I'm not sure how well it's going. I didn't see any recent reports. I know that he's having trouble with the, with his economic plans generally, like everywhere is because of this virus. But what he started to do was to create the largest bank in the country as a network of public banks called the Bank of the Poor. So he said they would be doing 2,700 branches in the first 2 years, and he was envisioning up to 13,000 branches. So the reason it was like Indira Gandhi, it was because the private banks are doing it, that we have these unbanked and underbanked out in the urban areas that they have to drive a couple of hours even to get to a bank. We're trying to get payments to them and we can't do it because there's no place for them to cash the checks or no easy way to get the money. So that he said the private sector is not doing it. So it's the duty of the public sector to step in. So I'll be interested to hear how that goes. But anyway, he definitely has the right idea there. And fortunately for him, he's got the backing of the military, the public. I mean, it sounds like even the rich investors are all for this, or all for his programs in general. As I've read, you obviously know more about it than I do, Betsy. So in a way, a crisis like this can slow you up. But in another way, you can use a crisis. Crisis is when change happens. And Roosevelt demonstrated this probably more than anybody else. I mean, the most amazing transformations happened in the 1930s. And people scratched their heads and said, like when he took the dollar off the gold standard, people said, can he do that? But he did it. It was just like when the Federal Reserve came out with $4 trillion of quantitative easing. And people said, can they do that? But there was nobody really to stop them, or nobody did stop them, and they did it. And it wasn't the big hyperinflationary disaster that was being predicted. And likewise, when Roosevelt took the dollar off the gold standard, and then so in 1933 the banks had collapsed, and they were saved with FDIC insurance. But in the meantime, Roosevelt took an existing public entity, which was the same thing that AMLO did, a smaller entity, and vastly expanded it. So the Reconstruction Finance Corporation was set up by Hoover, the previous president. And under Roosevelt, it was started with 500 million in capitalization. And by the time it was done in 25 years, it had lent or invested over $40 billion. It rebuilt the entire country. When the banks, the banks are bankrupt, and somehow the whole country got rebuilt with not just ordinary architecture, but this beautiful architecture and these paintings in the post offices, just amazing things that were done just by hiring people to do it and coming up with the money. The way they did it was they sold bonds, and mostly to the Treasury. So the Treasury, of course, just created the money on its books and called it debt. And the debt went up, but it didn't matter because the money was out there. They could spend the money, and they funded all this stuff. And they funded the World War, a major portion of World War II through this entity. And over 25 years, it did all that, and it still turned a profit for the government. So it's clearly the way to go. We need another one of those. It was really only disbanded because it was such a threat to the private banking industry that there was huge pressure on it, and it was disbanded under Eisenhower, I think, under a Republican administration. Meanwhile, in the 1930s, we had a very strong public banking system, and what Roosevelt's government could have done was to strengthen it rather than strengthening the private banks with deposit insurance. And that was the postal banking system. So you've got post office in every little community already. They're already there. You've got the infrastructure. You just have to open another window, as you see in this picture here, one for getting your stamps and one for cashing your checks. And that was very popular, particularly in the 30s, because it was very safe. So people were pulling their money out of the private banks and putting it in the postal banks. And the postal banks paid 2% interest on your deposit. So it was a good deal. And we could do that today. And there is a push to do that today. The postal banking system was closed in 1967, again, because of all this pressure from the big banks that were opposed to this competitor. And even now, there's still a big push to privatize the post office, particularly in 2005. There was a bill passed that required the post office to pay for a medical coverage for 75 years, 75 years into the future for their employees. Well, nobody else has to do that. That means you're paying for people that haven't even been born yet. Your young employees are not even born, and you're paying for their medical services. And so that is the major thing that's bankrupting the post office right now. But they clearly need some other source of revenue if we can't get that law reversed. And so we've got proposals for reviving the postal banking system. There are two bills on right now. One was by Senator Kristen Gillibrand and one by Bernie Sanders and Alexandria Ocasio-Cortez. So 25% of families or households in the country are unbanked or underbanked, and they pay up to 400% on payday loans. They pay on average $40,000 over a lifetime just in deposit and checking fees. So they could be there's definitely a constituency there to serve. There's a need, and the post office needs some more revenue. So it would be a great fit if we can get Congress to pass it. But this Congress seems bent on privatizing everything, state and local government, pensions, and the post office. So we'll see. Then there is the state bank possibility, and that's the one. So I'm chairman of the Public Banking Institute, and that's what we mostly do is try to get state banks set up. Our one and only model is a brilliant model. Fortunately, the Bank of North Dakota, it's been around for 100 years. I started writing about it in 2008 after after the collapse, because I knew that North Dakota was the only state that had its own bank, so I was watching it. And it turned out it was the only bank that escaped a credit crisis. It never went in the red. They had the lowest unemployment rate in the country, the lowest default rate, the lowest foreclosure rate, the most banks per capita, local banks. So I started writing about it and generated a fair amount of interest. And then we formed a Google group and went round and round in the issues. And a couple of years later, we formed the Public Banking Institute. And we've been advocating for this idea ever since. And it's picked up quite a bit of momentum by now. In 2014, the Wall Street Journal came out with an article that said the Bank of North Dakota was actually more profitable than Goldman Sachs and JP Morgan Chase, which is amazing. They had a return on equity that year of 18.5%. And actually over the last, somebody figured this out recently, I think it was 13 years or 18 years, I'm not sure. Anyway, they've had a 20% average return. So they just, every year they seem to do better than the last, even though oil is absolutely collapsed, and oil is one of North Dakota's big money makers. So the state has actually used the Bank of North Dakota as a sort of rainy day fund. They just take an extra dividend from their bank, and then they don't have to, raise taxes and all that. So why is the Bank of North Dakota doing so well? It's because they have their business model. They cut out they've cut out the middlemen. No private shareholders bleeding off profits. They don't pay bonuses, fees, or commissions. They don't have high paid executives. They don't have to advertise. By law, all of the state's deposits or revenues are deposited in the bank. So they have a huge deposit base, and they don't have to advertise for borrowers. They partner with the local bank. So it's really the local bank that deals with the customers. And then they turn to the Bank of North Dakota to help with liquidity and capitalization and regulatory requirements, et cetera. And the savings of this whole system are then passed on to the communities. So we've been at this for 10 years now, and we pretty much know what policymakers are going to say. And the first thing they say is, We've already got loan funds. We've already got lots of banks. Why do we need publicly owned banks? Well, the difference between a bank and a loan fund is leverage. One difference, you can lend 10 times as much if you are a bank. So for example, in California, we had the California Infrastructure and Development Bank. It's called a bank, but it's really a loan fund. And it's got a pool of money of $300 million, which it lends out and waits for it to come back, 3%. So it makes 3% a year on that pool of money. But it's got 20 times the demand for these loans as it actually is able to make. And if you use that 300 million and you turned it into, called that capital, you could have a $3 billion bank at a 10% capital requirement. You'd have to pull in the deposits, but right now you can get your liquidity. If you're having trouble finding it, you can get it from the Fed for almost nothing if you're banking good standing. I mean, that is one problem. We probably wouldn't be considered that to start off with, but you can see the potential is there. So you can make a lot more money, and you can make a lot more loans, even more to the point. So you can get all this credit into the community, which is money for the community, new money created by your bank that leverages your money instead of just lending it straight. And then for private banks, of course, they can leverage, but their fees are very high. Their loans are high, their interest rates are high, and they discriminate. We don't have control over where they make their loans. So a public bank, we could recapture all that control of where the money goes, what the interest rate is, governance, et cetera. Particularly, this is a good idea for infrastructure because on average, the cost of infrastructure is 50% financing. So if you can reduce your financing costs, you could save the state or a city a lot of money. And here are just two examples here. Bay Bridge retrofit, the taxpayers were told it would be $6 billion, but with interest, it was $12 billion. The bullet train, we were told it was $10 billion. It turned out to be $20 billion just for the portion that they finally abandoned. And another reason for public banks is that in a crisis like right now, they definitely come out on top. You can see from this little chart that this was in 2008, 2009, the private banks are on the left and the public banks are on the right. The private banks were pulling back. They were not making loans. They were afraid to go out there. They didn't want to take the risk of risky loans. And meanwhile, the public banks were pouring on the loans. China, particularly, it was China that really saved the global economy in that period. And they were just pumping out all kinds of infrastructure and funding it with credit through their public banking system. And public banks are able to service the community better. In this current crisis, North Dakota has distributed unemployment benefits through the Bank of North Dakota and its local banks 10 times faster than the slowest state. And small businesses in North Dakota have secured more payroll protection fund payment plan funds per worker than in any other state. So that's wrapping up. How do we capitalize on this crisis? Ideally, we would get the Federal Reserve to do helicopter money over the real economy. And to do that, we're going to have to get the ear of Congress and, do a lot of writing and speaking and, change the public perception of what it means to do helicopter money and why we need it and why it won't be inflationary. But we can use the fact of the crisis to point to the fact that they've just done it to the tune of $7 trillion for corporate America and for the stock market. They could do it for our half of the economy as well. And then state and local governments can capitalize on the crisis by setting up public banks. They can use the crisis as a reason to do this quickly, like maybe by executive order or by emergency legislation. We've seen that in a crisis, politicians are much more open to new ideas. And because the Fed has used this crisis to drop its interest rates for banks, though if we had our own public banks, we could capitalize on that bonanza as well. And then that would allow us to direct credit into our local communities where we particularly need it, which would stimulate the local economy, restore the tax base, and help to fix the problem of how on earth are state and local governments going to balance their books in this crisis. So this is just a map of our public banking movement at the moment. We've got over 25 bills that are currently pending and over 50 groups in different localities that are working on this project, approaching their legislators, amassing, raising public awareness, that sort of thing. So we're hopeful. We haven't actually gotten, well, there's the Bank of American Samoa that was formed last year. So that's our first public bank in this century. And that was obviously not even a state, it's a territory. But anyway, we've got great hopes. There's that in California that we have a very vibrant young people's movement. And New York also has a very vibrant young people's public banking movement. But in California, the California Public Banking Alliance got a bill passed, AB 857, which set out the requirements for a public bank charter. And now these 10 different cities and localities that form the California Public Banking Alliance are competing to be first, or they were. Of course, the crisis is slowing everybody up. So now their current push is for a new bill for a state bank that would turn the Infrastructure Development Bank into a true depository bank, which I think is a great idea. And so that's all I have to say for now. These are my books for further information, and my website, ellenbrown.com, has over 300 articles on this subject. And then publicbankinginstitute.org has all kinds of resources if you want to get involved or get active, where you can find other people or resources. Thank you very much.
Thank you so much, Ellen. And it's so encouraging to see the map of the US with all of these initiatives for public banks, all across the country. One always says that during a crisis, ideas that are just lying around sometimes get picked up and get implemented, or what was politically impossible then becomes inevitable.
Right.
And in 2 to 3 months, a huge number of people who live in the United States are going to find that their 3-month forbearance on the rent or their 3-month forbearance on their mortgage payments or credit card payments, car payments are going to come due. And they're not going to have the money to pay for it. And how could, people obviously do not, average people don't have access to the Fed's discount window. I tried, I'd like to borrow $1 billion at 0.25%. I thought I could do a lot for my neighborhood with that kind of money, but obviously only banks get that kind of loans. What would you propose to people who are sitting there thinking, well, I can get by this month and next month, but the following month or 3 months, I'm going to be evicted, or my house is going to be foreclosed. And we know that in 2008, millions and millions of people lost their homes. And we know that hedge funds bought up huge numbers of these foreclosed homes, and hedge funds, the wealthiest people in the country, are now, own a substantial amount of the rental property in the United States. Do you see any hope for some kind of public banking entity to be created that can help people? Okay, we've got through the virus, people are working again now, but if most people don't have an extra $400, they certainly don't have 3 months of back rent ready to just pay out. Do you see any possibility that the government might do something creative and open a discount window for average people to pay their back rent and their overdue student loans and their car loans? 8% of mortgages are already overdue. I don't know what the percentage on car loans is, but it's huge. Household debt today is $13 trillion. I mean, that's a huge amount of money. How are people going to, if they've been out of work for several months, come up with the money to pay their debts?
Yeah, well, the states don't have the money, so and they don't have publicly owned banks right now, and that will take. You could set up you could actually do the infrastructure for a publicly owned bank in, a month or two, but you've still got to get Federal Reserve approval if you're going to try to borrow there. And, you need to get a charter from your state regulator and all that. So there are hoops to be jumped through. So it will take some time. And so it's really up to Congress, and they are working on, another round of the CARES Act. And we'll see what they come up with. But what I try to do is just to write and to show that we can, the resources are there. It will not hurt our economy to open the sluice gates for regular people. You don't have to only prop up the stock market. You can prop up individuals, and it won't hurt. It will help you. It will put money back into the consumer economy, which means you'll get the wheels of production turning again. You'll have some demand, so that'll motivate people to start their businesses up again or whatever. I mean, this whole distancing thing is going to really put a cog in the works, because if you're a restaurant and you've got to space people out 6 feet away, and you could only have so many people, like you run it, I think I saw 30% capacity you're allowed to do. Well, you can't pay your rent on 30% capacity. So they're all going to fold. We're not going to have any little local restaurants anymore. It's all going to be the big chains. So it is a pretty desperate situation, and it really pretty much is up to Congress, which I'm on the other side of the country and can't say I have leverage there, but I do, we do have some people there who were working on people there. So we'll see.
And I was also wondering, do you know, a lot of our members and a lot of our winter guests are from Canada. Do you have any idea what the situation is with public banking in Canada?
The Bank of Canada had an excellent model right up until the 1970s, when they joined the Basel Committee, and went this independent central bank thing where the government was not supposed to borrow from its central bank, but was supposed to borrow on the open market, which meant that they had to pay a lot of interest. But before that, the Central Bank of Canada was funding much of things like their excellent socialized medicine program, healthcare, National Health Service. And now I know they tried to revive that. Rocco Gelato, I think, was the attorney on it, and he worked really hard, and but failed, lost that lawsuit. But as I mentioned, they did I think they have more leverage over their banks than our government does, because at least they managed to get their credit card rates down to cut them in half, which was good. That's about all I know about that. I know they have that excellent, I forgot the name of it. Anyway, that's, yeah.
A lot of small businesses we know are in trouble. And is there, do you think that there will be more money coming from the federal government for the small businesses and a process that is more manageable? And do you think that larger chains are going to fold as well? I mean, we can see that there's small family-owned businesses that aren't doing well, but Macy's is closing all over the place, and J.C. Penney's just declared bankruptcy, and it's shocking the number of huge, household name chain stores that we've been going to for 20, 30, 40 years are closing. Do you see that a new version of a CARES Act could help solve that?
Supposedly they are working on a second round of the CARES Act, but I don't have any inside information on what's in it. But you're right. I mean, there's definitely a need there. I mean, in general, even before this crisis, a lot of businesses, clothing type businesses, were going out of business because people have gotten so used to ordering stuff that you don't need to go out to buy a lot of things these days. I mean, I'm guilty of that myself. I've gotten so addicted to, I order my groceries delivered. I mean, of course, in this crisis, you can see why, but I was doing that before, because it was just, it's a good service. It was a lot easier. Anyway.
Michael Hudson has proposed the idea of a debt jubilee. If there's something like 1.5 trillion in student loan debt out there, 1.1 trillion in credit card debt, 1.35 trillion in auto debt. Do you think that a debt jubilee is possibly more politically manageable than the creation of public banks and very low interest loans like 0.25%, so that people can keep their housing, so that they can keep their homes and pay their bills that they're so far behind on?
Yeah, well, of course, one problem, it depends on how you're going to work it. Somebody's going to have to compensate the creditors. I mean, let's say you have a moratorium on rents. Well, some of these are banks and they can afford it. And, it's about time they took some hits because they've been making profits all this time. But some landlords are retired people that just rent out, several rooms in their house or something. I mean, there are people that rely on income from rents as so in other words, it's not fair really to the landlords or the creditors necessarily. The creditors may be pension funds, and you're going to bankrupt the pension funds. So the government has to pay that money, it seems to me, but that could definitely be done. For example, the government could just say to the banks, forgive these debts, just carry them on your books, and we're not going to make you balance your books. We're going to allow you to carry bad loans on your books. And that's what they do in China. And they've done it for a long time. People complain that the Chinese banks are bankrupt because they have all these non-performing loans and they're going to collapse. They're not going to collapse because the Chinese government is the regulator. They're not going to collapse their own banks. They don't put the banks into bankruptcy, and they don't put the businesses into bankruptcy because they figure it's better to have people working. And even if it's not totally profitable, as long as they're producing something, it's kind of like Roosevelt's dig ditches and fill them back up. They want the people out there working.
Right.
hurt to have non-performing loans on your books as long as your regulator will allow you to do it. You know, we could just need to redo the system. But then the complaint will be, well, that'll be inflationary because you're going to leave a lot of money out there that doesn't have to get paid back. So that's going to add money to the system. But so those are the arguments I keep making, is that it's not inflationary. We're in a deflation. We're in a massive deflation.
Exactly.
Or that money into the real economy. Plenty of money has been poured into the financial economy, but it's siphoned. It does not trickle down. It trickles up and it doesn't come back.
You seem to have definitively countered the accusation that will cause, putting more money into the system will cause inflation. It won't. The problem is
it would at a certain point, of course.
I have another question from one of our listeners. To what degree does the dollar as a universal currency give the United States the ability to sustain a higher level of debt than other countries? And this questioner also would like to know, what is your position on MMT, modern monetary theory?
I agree. We can go heavily into debt, but the problem with the MMT, to me, I mean, I certainly totally agree that the government should be issuing the money, and that we can put a lot more money out there than we're doing now to, you know, if it goes in the right place, if it goes into productive pursuits and not into asset inflation. The one thing that I don't think is necessary is driving up the federal debt, unless, of course, you're going to have the Federal Reserve buy all of that debt and return the interest to the government, and keep rolling over the loans, in which case it's basically free money. And that's what I think should be done. But the way our system's structured now, the Congress can't rely on the central bank to buy the debt. They just have to put the debt out there, and then the central bank can buy it or not, as it will. And if they don't buy it, it goes into the regular bond market, and then we wind up paying, you know, that will be the problem. We'll be paying $1 trillion in interest if they let interest go up the way it used to. But now Japan does own 50% of their debt is owned by the Bank of Japan, and that seems to be working out fine, as long as they don't have to sell it back, or don't try to sell it back.
It seems like there are an awful lot of zombie corporations out there, corporations that don't make enough money to even meet their, service their debt. And as an advocate of cooperatives and self-management, worker-owned, worker-run enterprises, it's always seemed to me that that businesses that don't make a profit, or businesses that are having trouble making a profit, should maybe look at the salary or the compensation packages that are paid to CEOs and upper management and boards of directors, and dividends that are paid to shareholders. If more businesses were worker-owned and worker-managed, wouldn't that make the bar for what would be considered profitable much lower? Obviously, if my husband wanted me to pay him $10 million a year to make coffee every morning, you know, we would have a real problem with our family budget. But without these high-paid CEOs, I think a lot more businesses would be profitable.
Yeah, agreed. And I think one problem is, I know this is the American model, to try to go public and sell off your business to shareholders, but then that puts the shareholders in control, and then they want to make as much money as possible. That, of course, is their number one mandate. And they don't have a personal interest, and they don't know the people. And they're perfectly happy to, I mean, they don't even know that people are getting laid off. All they know is that they've got management in there that's doing whatever it takes to make as much money as possible. They may have these corporate raiders that come in and, the shareholders, either they don't know what's going on at all, like most of it, like the little shareholders that happen to just own stock in the stock market. And to them, it's just letters on a screen, 4 or 5 letters, and the numbers go up and down, and that's all they know about it. Whereas if you kept ownership of your business, like you say, if the workers kept the ownership, and if you need funding, borrow it from a bank. I think it's better to have loans. That's the European model, where the businesses are more likely to borrow from a bank than to, or small and medium-sized businesses will borrow. I think it's better to borrow, and because then, particularly if you have a network of public banks where the bank is not trying to bankrupt you, they're actually trying to work with you. And in fact, the Sparkhouse banks, if you don't have any collateral and you don't have, any way of showing that you've got a credit history that you can pay this loan back, the Sparkhouse banks will actually look at your business model and help you with it, and say, well, we're not sure this would work. What about trying this way, whatever. So, they really are a partnership, and they're trying to see their businesses succeed, and they're nonprofit. They're not trying to make a profit. They don't want to loss. They operate on prudent lending standards, but like you said, they're cutting out those big moneyed people that are sucking the profits out.
Right. And other cities like Bologna in Italy, which is a huge center of cooperative businesses, the city government provides services to businesses on how to make a business plan. They provide accountants. They help small people actually survive as a business rather than trying to suck every ounce of blood that they can get from them, which is a very different model from what we see in the United States.
Yeah. I actually think the worst thing about our capitalist model, as we were discussing before we started here, is that we allow people to become extremely rich, which allows them to buy government. So we, the people, are no longer, we think we're in a democracy, but there have been studies that show that politicians do not really pay attention to what the people want. They pay attention to what the big moneyed lobbyists want, or the money that's going to support their campaigns. That's what's really significant to them. And we allow people to become so powerful that they can buy up universities and these giant alleged nonprofits that are, these charitable organizations that are really just calling the shots on, well, for example, this virus situation right now. But anyway, the fact that we're really not a democracy anymore, we're really a corporatocracy. And if we want to get back to a people-run system, we have to start with the financing part of it.
Yes, we do. Someone has written in saying they're trying to donate, and we do appreciate donations since we have ended all of our revenue and raising programs. And please write to us or go to our webpage and try to donate through the donate button. And if it doesn't work, just write to admin@globaljusticecenter.org and explain your problem, and our wonderful administrator will take care of it for us. I also wanted to ask you, Ellen, if there's some way, I agree that people having so much money that they can buy the politicians and buy the judiciary and buy their whatever, their way into college for their children, and it hasn't always been this way. There used to be an ideal of equality in our society. Now, this is an idea that, of course, comes from the French and British Enlightenment in the 18th century. But there used to be the idea that, equality among people was good enough. And of course, it's sad that has evaporated. But wouldn't something like a universal basic income and guaranteed health services delivery, what people want is security. They want to know that they're not going to be homeless, that they're not going to be starving to death, and they're not going to be sick. And people think that with money, they can guarantee all of these things for themselves. But couldn't we, as a society, guarantee universal basic income, healthcare, housing, so that people wouldn't feel like, oh my God, I have to have at least $5 million to retire on? If everybody thought they needed $5 million to retire on, nobody would ever retire.
Yeah, I totally agree. I think that you never feel secure in this system. Even no matter how much money you have, if you have a lot of money, you probably have a big house with a very big mortgage, and you're still worried about money because your investments could go bad or whatever. Everything is uncertain. If we had a floor, like you say, did those basic things covered, and it's certainly been done before, like the Scandinavian countries where they pay maybe 50% of their income goes to taxes. But ours, if you count all the taxes and the hidden taxes we pay pretty close to 50% too. I think it's 40%, something like that. And we don't get anything like the services that they get. And they just are, I mean, I think maybe things are getting chipped away now, but as they are everywhere. But that's a model that we've certainly seen in history that has worked very well to make people secure. And if you've got that baseline security, you don't really feel the need to acquire more and more and more. That drive to always accumulate. It's this sense that, well, we're never quite have enough. We better save that because we really don't know what's coming in the future. And whereas if for example, if you live in a family and you know that the family is going to provide for you, you're not out there scrambling for stuff. You just, you only take what you, I hate to sound communist, but from each according to, you take what you need, and that's it. That's all you have to worry about. Or I've lived in third world countries quite a bit, and at your subsistence level, that's all they worry about. I mean, they don't have to have a fancy outfit for every occasion. They only need a shirt and, a pair of socks that'll keep the water out of their shoes or whatever, that'll keep their feet dry. So it's just a difference. And we may revert to that now that from this virus, we may have so many poor people that our whole standard of what's good may change, which wouldn't necessarily be a bad thing. I mean, we may find other ways to entertain ourselves besides always spending money or having very expensive.
Well, certainly the post-COVID world is going to be quite different from the pre-COVID world. And we're going to have to work very fast to do something about the climate catastrophe that is upon us. And just the limits within nature are going to limit the amount of yachts that can be built and helicopters for private transportation and so forth and so on. But in these times of crisis, ideas that are just lying around, such as universal basic income. When Congress added $600 a week to every unemployed person's paycheck, that made a huge difference for people. And yet it was such a small amount of money. JP Morgan would not have been happy with $600, but most people are happy with that, added to their weekly paycheck. Um, and of course, the idea of Medicare for all or socialized medicine. Richard Nixon supported the idea of socialized medicine. More than half of the US population has wanted
Sorry about the telephone.
socialized medicine since World War II. And yet we still haven't gotten it because the politicians are beholden to the health insurance industry. There are a number of industries that are just simply not even necessary. Advertising is one. The arms industry is another. While we're thinking of new ideas and how to create a better world going forward, and not a world where half of the population is living in the streets because they got thrown out of their apartment or their house was foreclosed on. We've got to get good ideas that we know will work into the public discussion. And I know that's why you're writing like crazy every day. That's why we at the Center for Global Justice are working on having these weekly programs precisely to propose solutions that are possible, that are not pie in the sky, and that actually really can work. There are thousands of academics who've been working on these ideas for years, the same way that there are thousands of medical personnel who've been working on viruses for years. And there should be a solution to that problem as well. Would you like, before we conclude, is there anything else that you would like to add, Alan? I've enjoyed very much this conversation we've had, and I think our listeners, a lot of our listeners have as well.
No, thank you very much, Betsy. I've enjoyed it as well. Wish I were there, but.
Well, you're welcome to come visit anytime. If you could just figure out how to get a flight from LA to Mexico City. For our listeners, I want to thank you for tuning in again today. And if you are able to do so, to make a donation to our ongoing expenses, that would be wonderful. Next Monday, we're going to have a program with Cynthia Kaufman and Bill Fletcher. Police versus the people. Are there alternatives? So finally, we were getting a real discussion on racism in the United States. And what do people need? They probably need a social worker most of the time when they call 911. And then the following week will be Cuba and COVID, a country that actually had a sensible response to the COVID pandemic. And the ambassador from Cuba to the United States, Jose Ramon Cabañas, will be on the program, as well as Al Campbell and Victor Wallace. So that will be July 27th. Next Monday, July 20th, will be Cynthia Kaufman and Bill Fletcher on police versus the people. And I would like to thank our volunteers, Colette Moria, Liz Mestres, Cliff Duran, Gregory Diamond, Roberto Robles, and our speaker, Ellen Brown, and hope to see you next week. Thank
Thank
you.
you, Betsy.
Thank you, Ellen. Okay.